Holders of U.S. Treasuries, holders of U.S. corporates, particularly investment grades, have been big winners just recently. Well, where should you be putting your money within the credit markets next? We've got Gibson Smith. He's the co-chief investment officer of fixed income at Janus Capital Management. He oversees $17.2 billion of the more than $170 billion the firm has in assets under management. Well, Gibson joins us now with his perspective. And, hey, it's been good to own bonds lately.
It has.
At least on the longer end of the Treasury curve. We saw the short end, spiking up there in terms of yields for a short period of time. But what's your read on the reaction yesterday to the agreement coming in? We saw stocks sell off, and we saw Treasuries rally once again.
Yeah, I think the bond market is sending a lot of signals post the resolution in Washington. One, of discontent with the process that we saw in Washington, but more importantly around concerns of economic growth and the sustainability of that growth.
So where do you put money now? I mean, how much longer do Treasuries have to run in this direction? How much lower can they go?
Well, it's been really interesting. If we go back to the 2008 crisis, where there was conservatorship of Fannie and Freddie, we've seen a fundamental and structural change in the fixed income markets. From our perspective, the best values, the best risk-adjusted returns are available in the credit markets, both investment grade and high yield.
Are there particular sectors that you like best? We were looking earlier in the week, actually, at Walmart, Oracle, AAA-rated companies, and their performance has been outstanding in terms of their corporate debt. Where else do you look?
You know, I think from a fundamental bottom-up standpoint, you're finding opportunities across all sectors, but it has to be on an individual security basis. We look for companies that are going through positive fundamental transformation of their balance sheet, companies that are paying down debt, improving their financial position. That's where the real opportunities are in the credit markets.
You know, would you say in some odd way that maybe having had this scare in Washington actually got a lot of companies thinking about strengthening their balance sheets in some odd way, which I think, I mean, what's your opinion of that? Did that actually make a number of our companies stronger?
I think in a perverse way, what happened in Washington, highlighting the high leverage at the federal level, from a corporate manager standpoint, a CEO, a CFO, you have more power if you have financial flexibility, if you have a strong balance sheet, if you can navigate more difficult and uncertain times. So I think that message is loud and clear. It's been in the market since the '08 crisis, and I think it's going to be a theme that's going to be with us for quite a while.
Let's turn overseas for a moment. I know, Gibson, that you actually, you're underweighting emerging market debt. It's the only thing that you're underweighting within the credit markets right now. But when I was looking at 5-year credit default swap spreads, sovereign debt spreads. And, you know, in many cases, we're seeing like Mexico and Brazil trade at a tighter spread than we're seeing a number of European sovereign credits. So is that an opportunity to get into European sovereign credits or European companies at this point?
It may be, and I think you bring up a really good point. The emerging markets we know today are very different than the emerging markets we knew just 5 years ago. You mentioned Mexico in particular. When we look at emerging market debt valuations, from our perspective, we think there are far better opportunities in the European and the U.S. high yield markets, where you have companies going through that positive fundamental transformation. Credit risk at its core, in our opinion, is easier to analyze than sovereign risk.
Now, I'm looking at your portfolio now, at the Janus Flexible Bond Fund, one of several portfolios that you oversee. You've got 19% in Treasuries at the moment, 45% in credit investment grade. Is that a pretty typical asset allocation for you?
It's not, actually. We use Treasuries as an insurance policy in our portfolios to hedge against uncertain events. Our default, or our home base where we add the most value, is through individual company analysis, the credit markets, where we can find those great opportunities. The weighting in Treasuries will move up and down based on the market volatility and the outcomes that we see.
So is this a pretty high level then for you in terms of Treasury percentages?
You know, back in '07, going into the '08 crisis, we had many of our portfolios sitting with 70 and 75% in U.S. Treasuries. When we look at the portfolio positioning, we're looking for the best risk-reward opportunities, the best risk-adjusted returns. And we have to remember, we're a bond fund. We're supposed to perform like a bond fund. So preservation of capital becomes a very important element in how we position.
And let me ask you, connect the dots for us between the equity and the debt markets, right? We're looking at the equity market selling off one day after the next. At what point does that impact what's happening on the debt side of the balance sheet for these companies?
Well, there's clearly a correlation between the equity markets and the credit markets. And from our perspective, we look at a company holistically. As credit managers, we like to see equities going up, but importantly, we want to see management teams that are focusing on financial strength, stability, and liquidity within their capital structures.
All right, Gibson, we got to leave it there. Do appreciate you joining us. Great to get a 360 look at the credit markets. Thanks so much. That was Gibson Smith, Co-Chief Investment Officer of Fixed Income at Janus Capital Management.